Edge designations, CFA Level 1, pre-reading economics, learning module 3, aggregate output, prices, and economic growth. This is the second video in learning module 3. Let's get ourselves going. Carrying on from where we were, talking a little bit about aggregate supply, okay, and aggregate demand. Learning outcome statement, explain causes of movements along and shifts in both the aggregate demand and the aggregate supply curves. Okay, and remember we spoke a little bit about before, okay, there's an inverse relationship, and I'm talking more about the demand side now. There's an inverse relationship between prices, the general price level, and quantity of goods demanded. Okay, goods and or services demanded. What do we know? As the general price level starts to fall, okay, people that are holding money, even though, as we've mentioned many times, even though the amount of money that they are holding onto doesn't change, their income levels remain constant, but as prices fall, people inherently become more wealthy. Okay, as price levels fall, real interest rates fall, and local goods and services become cheaper relative, okay, to goods and services. Can you see we're dealing with all of the various components of what we've dealt with up until now? Savings, interest rates, exports, imports, etc. As a result, the quantity of goods and services that people require goes up as well. Okay, what are some of the factors that will shift the aggregate demand curve? And remember, the aggregate demand curve can shift to the left or it can shift to the right. Okay, some of the factors that would cause that: changes in real wealth, changes in the real interest rate, okay, changes in expectations of businesses and households about the future direction of the economy, changes in the expected rate of inflation, changes in income abroad, changes in exchange rates. Over our page, changes in fiscal policy as well as changes in monetary policy. Okay, and you can see over here, okay, there is the aggregate demand curve. You can see it's not, we've now incorporated a bit more real curve over here. Okay, the aggregate demand curve, okay, it's not completely linear. Yes, we still see that it is downward sloping, indicating the inverse relationship, yes, then between prices and quantity over there, but it's not completely linear and shaping downwards. Let's have a look over here. Let's start off with household wealth. Okay, as the wealth of households increases, they can afford more goods and services at the particular price level. Now, this is when their wealth actually does increase. Okay, and that'll shift the aggregate demand curve then to the right. The same thing will happen with a decrease in wealth. The aggregate demand curve then will shift to the left. Okay, what about changes in real interest rates? Okay, if real interest rates fall, okay, now what happens? It's cheaper now as a result of the lower interest rate for consumers to buy items such as cars, houses, and things like that. Okay, and it's also cheaper in terms of opportunity costs for business to invest in projects now than it was in the past. Okay, again, we will experience a right shift in the aggregate demand curve. Same thing will apply. We can experience a left shift to the demand curve when there's an increase in real interest rates. Okay. Changes in the expectations of businesses and households about what's going to happen to the economy going forward. If there's optimism about the future expansion of the economy, that starts to encourage householders and they start to invest in bigger items, okay, shifting the demand curve there to the right, and vice versa if there's pessimism about the economy. What about change in the expected rate of inflation? Okay, let's say, for example, there's an expectation that prices will increase in the future. Okay, that'll cause an increase in the aggregate demand for goods and services in the current period, because what are you expecting? You think that in the future prices are going to go up, so you better get involved now. Okay. If inflation is expected to decrease or to go down in the future, then the current aggregate demand curve will decrease and shift to the left, okay, because people will say, well, hold it, I'm not going to buy anything now, let me rather wait then until prices go down. What about changes in income abroad? Okay, when your trading partners are experiencing economic growth and their income is increasing, okay, then their demand for exports will increase. And again, that'll shift our aggregate demand curve, because we're going to expect an increase then on their parts for our goods. So that'll shift the demand curve then to the right. Okay, a recession, same story. Okay, but on the other side, it's going to shift to the aggregate demand curve then to the left. Changes in exchange rates. Okay, what does that do? If the dollar, let's say, for example, appreciates against another, the dollar becomes stronger. Okay, now the problem is a very strong domestic currency, okay, makes it difficult for foreigners to purchase your domestic goods, because your currency is so strong. They need to spend so much more to get it to buy your domestic goods. Okay, and that'll shift the demand curve to the left, reducing demand. And that's often, by the way, guys, why you find that certain countries like to depreciate their currency or keep their currency weak. It's good, very good for exports. Okay. On the reverse side, here we go. If the dollar depreciates, the US would export more, import less, and net exports would increase, and your aggregate demand then would shift to the right. Okay. Let's talk about fiscal and monetary policy. Okay. Fiscal policy, okay, is the use of things like taxes and government spending to impact the level of demand. Okay, and we see over here, okay, an increase in government spending, okay, which, by the way, hopefully by now we all know that that is one of the key components, one of the direct components then of aggregate demand, will shift the curve to the right. A decrease in government spending will shift the curve to the left. Okay, there we go. Taxes, what about taxes? Taxes have got more of an indirect impact on consumer spending, because if there's lower taxes, there's more money to spend, and it'll shift the curve to the right. If taxes are very high, there's less available cash to spend, and that'll shift the curve then, yes, to the left. Monetary policy, okay. Monetary policy, okay, generally, okay, we define that as currency in circulation, okay, as well as deposits at commercial banks. Okay, monetary policy refers to the actions that the central bank, the Federal Reserve, take, okay, and changes things like the reserve requirement that banks are required to hold, target interest rates, etc. Okay, when the central bank buys security from banks, it pays for them with an increase in bank reserves, okay, and that then will increase the number of deposits that the bank can accept, and money supply then is improved. Okay, same thing when they cut the required reserve ratio, they say less money is needed to be held on reserve. That'll increase the level of deposits. Okay, and we see that over there. Top of page 24. The diagram here shows us the short run and long run effect of expansionary monetary policy. Okay, and let's talk here that the central bank expands the money supply. Why would the central bank expand the money supply? They want to stimulate demand when the economy is already in what we call a long run equilibrium. What would that do? The expansionary policy shifts the demand curve to the right, and then we move from aggregate demand curve 1 to aggregate demand curve 2. Okay. In the very short run, that's the short, we speak now short run, very short run. Okay. In the very short run, output will expand from Y1, okay, to Y2 to match that, and we should not experience much of and you can see over there, it's the very short run supply curve. Okay, that's on the supply side. in the very short term, no increases in prices. However, after operating at the higher than normal production rates for a few months, a few quarters, for however long that is, companies say, well, hold on a second, we've been supplying more, we're going to be pushing for higher prices, okay, and input prices start to rise as well. Then what happens to the aggregate supply curve? It starts to steepen, okay, and prices, yes, in fact, do end up increasing, okay. As input prices become more flexible, the aggregate supply curve steepens further, and as we know, in the long run, it becomes vertical. Eventually, there's the long run supply curve. It moves from being there in the very short term, more short term, it starts to steepen over there, moving to the left. Eventually, it becomes vertical. Okay. What are some of the factors? Okay, and we're going to go through these now. Okay, that cause the aggregate demand curve to shift. We've seen all of those there, and it's just a nice little summary for you there. We move now, we've dealt with the aggregate demand curve. Now we ask ourselves the question, what are some of the factors that will cause shifts in the aggregate supply curve? Okay. Here we need to consider, as opposed to the aggregate demand curve, which was a little bit easier, we need to consider the short and the long run supply curves. Okay, top of page 25. The long run aggregate supply curve is vertical. We've showed you that on the previous page. Okay, and what does that tell us? That says that the maximum sustainable quantity of goods and services, okay, that any kind of a country can produce with their available resources, okay, and the technology available and everything that they need to have in place. That's in the long term. What about the short run? In the short run, the curve is upward sloping. Okay, we're not talking about the very short run. Okay, we're talking about just the short run supply curve. That indicates that the various quantities of goods and services that domestic firms supply, okay, as we start to experience changes in demand conditions, okay, changes the levels of prices of goods and services in the market. Okay. What is the relationship between shifts in the short and the long run aggregate supply curve? If the change in aggregate supply is just temporary, okay, for example, there's a fantastic period of good weather, increases farming output, or on the reverse side, a drought that decreases output, okay, then only the short run, okay, aggregate supply curve will shift. Output, okay, after the exceptional period is over, it's just going to return back to its normal level. However, if the change is permanent, okay, and it causes a permanent change in productive capacity, the supply will change both in the short run and in the long run, and then both the short run and the long run curves are going to shift. Okay. What are some of the factors that change the cost of production or profit margins, okay, that then will cause the short run curve to shift? We've got changes in wages, changes in input prices, expectations about future prices, taxes and subsidies, exchange rates, and supply shocks as well. Let us go through these various factors. First and foremost, let's talk about change in nominal wages. Okay, a change in wages shifts the aggregate supply curve. Okay, why? Because remember, as an input into what we can supply, wages are often one of the largest components of a company's costs. Okay, an increase in wages, okay, will do what? Because it's such a large input into the process, will cause our production costs to go up, resulting in a decrease in supply. Okay, it becomes too expensive, and a leftward shift in the curve. Lower wages will shift the supply curve more to the right, and more will be supplied. Okay, over our page, we've just got a nice little formula over here. What is the change in the unit labor cost? The percentage change in unit labor cost is the percentage change in nominal wages and less the percentage change then in productivity. Because remember, those go hand in hand, the actual wages themselves as well as the level of productivity. Okay. What about a change in input prices? Okay, let's say, for example, there's a reduction in the price of resources that are used to produce my product. That'll cause a decrease in costs and cause the supply curve, short-run supply curve, to shift to the right. Okay, it may not do much to the long-run curve. We'll talk about that in a second. An increase in prices will cause the short-run curve then to shift to the left. What about changes, and this is not the actual, but changes in the expected rate of inflation? Okay, if suppliers are expecting inflation to increase in the future, what's he going to do? Okay, he's going to cut back on his current supply. Why? Because he says, hold on a second, prices are going to go up in the next quarter. I'm not going to supply so much now. Let me rather cut back on supply, and I'll supply most of my stuff when the prices are higher. The supply curve in the short run shifts to the left as he chooses to supply less now. If the supply expects inflation will fall in the future, well, he wants to sell everything now. Supply curve now will then shift to the right and increase. Okay. Changes in taxes and subsidies. Okay. If there are higher business taxes, okay, that'll cause the production costs per unit to go up, and it'll shift my supply curve to the left. On the reverse side, if I'm getting subsidies, that will reduce my costs and shift my supply curve then to the right. What about change in exchange rate? Okay, one of the key inputs is obviously raw materials, and a lot of countries import their raw materials, okay, in order to and form a part then of their production process. As a result, changes in the rate can also affect the costs of production. Okay, a higher dollar relative, for example, to the euro will lower the cost of raw materials coming into the US from Europe, lower the American producers' production costs, and then the American supply curve will shift then to the right. Supply shocks. What's a supply shock? It's an unanticipated event that temporarily will increase or decrease the output. Okay, this gives what we spoke about this a bit earlier. For example, very good weather, okay, or decreases in the price of an imported resource, things like oil. Curve is going to shift to the right. The long run curve will remain unchanged. Adverse weather conditions will cause the short run curve to shift then to the left. As we say, since it's only temporary, the position of the long run curve, okay, will then remain unchanged. Okay, shifts in long, so we've had a nice long discussion. Well, it's a wrong word. We have a long discussion on the short run aggregate supply. What about shifts then in the long run aggregate supply curve? The position of the long run curve, for the most part, is determined by the potential output of the economy. We don't look at what it's actually doing now, because in the long run it has more legs in it. It can probably do a lot more. So we look at the potential. Potential GDP measures the productive capacity, and that's the level of real GDP, assuming we are at full employment. Okay, potential GDP is not a static concept, okay, but can increase on an annual basis then as the economy's resource capacity grows. Okay, any factor increasing the resource base of the economy will cause the long run aggregate supply curve to shift. Let's have a look at a picture. Okay, and there we go. So, but it's got to be a long-term change. Then my long-run curve, which we know the long-run supply curve is vertical. If there is a permanent change in resources, that will then cause a shift of the long-run curve then to the right-hand side, and output would increase. Okay. So what are some of these factors that could be of a permanent type nature? Okay, that will have a long-term impact on the potential economy and cause the long-run aggregate supply curve to shift. Supply of labor, natural resources, physical and human capital, as well as productivity and technology. So supply of labor, the larger the supply of labor, the more output the economy can produce. Okay, and that of course, and what causes that to shift? Growth in the population, the labor force participation rate, how many people are looking for work, and net immigration. Okay, supply of natural resources. Okay, if there were an increase in available natural resources, that'll cause again the long run curve to shift then to the right. Supply of physical capital, things like property, plant and equipment, software. Okay, all of these are key ingredients then for growth. Okay, and again that will cause a shift in the long run curve. Top of page 28, supply of human capital. Okay, another way that we can raise the productive capacity of a country is to increase its human capital. Okay, the quality of the labor force, things like training, skills development, education. Again, that would cause a shift in the long run supply curve then to the right. Labor productivity and technology. Another key factor that affects that is, of course, the labor productivity. We'll talk about that. Productivity measures the efficiency of labor and how much output produced by workers within a given period. In other words, how many items can they produce in an hour, a day, or things like that. Okay, if you can increase productivity, that'll take your labor costs all the way down and improve your profitability, higher output. What are some of the key drivers of productivity? Physical capital per worker and the quality of the workforce. With those ones we've spoken about already. Another key determinant, which is the third element, is technology. Okay, again, and if you can improve your technology, you can then get your long run supply curve then, yes, to shift to the right. Got a nice table for you. Okay, what causes shifts in the supply curves, both in the short run and in the long run? There we go. We carry on. Next learning outcome statement. Describe how fluctuations in aggregate demand and aggregate supply can cause short-run changes in the economy as well as then in the business cycle. Okay, the business cycle we know is a direct result of short-term changes in real GDP. Okay, the business cycle goes through periods of expansion, contraction. Okay, when the business cycle is in a period of expansion, real GDP is increasing, unemployment is going down, and the capacity utilization is going up. When there's a contraction, real GDP is going down, unemployment rate going up, and the capacity utilized is going down. The business cycle reflects shifts then in aggregate demand and the short-run aggregate supply. Long-term sustainable growth rate in the economy, yes, will depend on growth in the supply and quality of inputs. What are our inputs again? Labor, capital, natural resources, as well as advances then in technology. From an investment perspective, macro analysis and forecasting become important because business profit, asset valuations, interest rates, and inflation rates will depend on the business cycle, at least in the short to intermediate term, as these will be key drivers for economic growth. Top of page 29, two learning outcome statements. Distinguish between the following types of macroeconomic equilibria: long run full employment, short run recessionary gap, short run inflationary gap, and stagflation in the short term. And explain how short run macro equilibrium may occur at a level above or below full employment. Okay, first and foremost, here's our first picture. Here's a market in long run equilibrium. What do you notice? Of course, everything fits the picture nicely. The aggregate demand curve then is downward sloping, an inverse relationship between price levels and goods and services supplied. We know that one well. Okay, the short run aggregate supply curve is upward sloping. It's got a positive relationship, yes, then between amounts supplied and price level, and of course the long run aggregate supply curve is vertical, and we've seen all of that before. Okay, and that is in long run equilibrium, everything is working. We start off and talk first about a recessionary gap. Okay, as a result of cyclical fluctuations in real GDP, okay, and prices, okay, that's going to cause, remember, not my long run, but my short run supply curve as well as my aggregate demand curves to shift. If there's a decline in demand, okay, a decline in demand would cause a left-hand shift then in the demand curve, lower GDP, lower prices. What would this cause? Okay, probably on our way to things like economic contractions. If this decline, okay, drive demand below the potential GDP, well, then the economy will go into what we call a recession. A recession, just we know the definition, of course, it's with two periods of negative GDP, but a recession is a period during which prices and goods and services are low, okay, relative to the costs of the production. Okay, what caused that? Either an unanticipated decrease in demand or an unfavorable supply shock. Okay. Top of page 30, unanticipated decrease in aggregate demand. Okay. If there's been an unanticipated decrease in aggregate demand, this could be one of the causes, okay, of a recession. What happens? Okay. All of a sudden, for whatever reason, aggregate demand starts to go down. Remember, as aggregate demand goes down, that will then shift the curve then to the left. Okay. Firms start to reduce their output and can even close if the production costs remain unchanged. What about an unanticipated or an unfavorable supply shock? Okay, let's say, for example, in the resource market, okay, there's a supply shock like a drought, high oil prices or things like that. Okay, that will result in the supply curve shifting leftwards, the price of resources and the costs of production therefore will increase, and that's the recessionary gap. Okay, something interesting, of course, to notice from the recessionary gap, the long run supply curve, well, that stays pretty similar, doesn't it? Okay, but what happens over here? Okay, the aggregate demand curve shifts to the left, where there is less demand over there. Okay, and equilibrium now moves from point A, then yes, to point B. Prices shift downwards then as a result from price 1 to price 2. Okay, and can everyone see over there? Okay, because of the decline in demand, companies say, oh, hold on a second, demand's gone down, they reduce their workforce, unemployment goes up, and the economy finds itself in a recession. What is the recessionary gap? It's the difference between Y1 and Y2. Okay, and by the way, remember, if point A is equilibrium, as I move away from there, well, remember, if that is equilibrium, that's where that's where the economy is operating at its maximum potential. Okay, as it moves away then from point A to point B, the economy is now operating below its potential GDP. Okay, there we go. Let's move down to inflate. What is an inflationary gap? Okay, and an inflationary gap, increases in aggregate demand lead to economic expansions, real GDP, employment goes up, and if it starts to drive the economy beyond its normal capacity and it starts to really heat up the economy in a massive way, okay, in a sense it's a good thing, but on the other side also keep in mind, what would that do? That'll cause inflation. Okay, let's have a look at an inflationary gap. High government spending, lower taxes, a very positive outlook among consumers, okay, and a weak domestic currency. It means imports, okay, so exports will increase, okay, rising equity housing prices, all this kind of good stuff is going to cause the aggregate demand curve then to shift to the right. If the supply curve doesn't increase to match that, there's going to just be really an overall increase then in prices. That's all, because the supply remains the same. Okay, I'm starting to bore everybody now. Long run aggregate supply curve sits over there. What happens? Aggregate demand was over there, 81, but as a result of a huge increase and in all things good, everything starts to go up. Consumers want more. Aggregate demand shifts then to the right. Okay, and as a result, there we go. Okay, starts to, and this is where we refer to, I think, called an inflationary gap. Okay, it shifts the equilibrium level of GDP from point A to point B. We were there, we're moving now to there. Okay, real output goes from Y1 to Y2. But the problem with that all, guys, is that prices go up as well as a result of the increase in demand. Once the economy reaches potential GDP, companies now have to pay higher wages and other input prices if they want to increase their levels of production. Now the problem is now we're in what we call an inflationary gap, which is the difference then, yes, between Y1 and Y2. Okay, and what causes that? Okay, it's a short run level of equilibrium is above the potential GDP. So remember, if we stay at the equilibrium level, everything will be fine. The minute we move above that level, we're going to have a problem. Okay. Stagflation, one fancy word. High inflation and high unemployment. So sometimes it's not so bad if you've got high inflation. Of course, inflation is not a positive thing, but it's not as bad if you've also got a lot of employment. But here, stagflation, you've got high inflation and high levels of unemployment. Okay, and structural fluctuations are caused by when my short-run supply curve shifts. I've got declines in aggregate supply, which brings about increased inflation as well as increased levels of unemployment. Okay, and we see over here, look what's happening. There's my short-run supply curve shifts upwards or to the left a little bit. Okay, and what does that do? You can see over here that shifts output to the left. In other words, output goes down. Unemployment would therefore rise if we're not producing as much. But the problem, the associated problem, is as the short-run curve shifts upwards, prices go up as well. Okay, so I've got inflation then together with unemployment. Okay, there we go. Okay, how do we combat this? Policymakers can use fiscal and monetary policy to also shift the demand curve then to the right. But the problem is, as soon as you start to shift demand as well to the right and increase the demand, well, you're going to make your prices more, your higher prices more of a permanent nature. Okay. We continue onwards. Analyze the effect of combined changes in supply and demand on the economy. Okay. The business cycle and the resulting fluctuations in real GDP caused by shifts in demand and supply curves. What are some of the impact that these shifts can have? An increase in demand, okay, will cause real GDP to go up, lower unemployment and increased price levels. A decrease in aggregate demand lowers GDP, increases unemployment and decreases prices. An increase in supply raises real GDP, lowers unemployment and lowers price levels. But if there's a decrease in supply, that'll lower real GDP, raise the unemployment rate and raise the general level then of prices. Okay, and there we go. There is your impact then. Okay, if both curve shifts, okay, the effect is just a combination of the above. And let's just have a look at one. If aggregate demand goes up, supply also goes up, GDP goes up, and price levels is an intermediate impact over there. Okay, so when are we going to get quite a nice increase on prices? If supply goes down, there's less available, the demand goes up, then of course prices will go up there as well. Top of page 33, describe sources, measurement, and sustainability of economic growth. Economic growth and sustainability, and we've spoken about this a little bit before, that we measure economic growth by changes in GDP or real capita GDP. GDP, we've spoken about already. Per capita GDP is just to take the entire GDP measure and divide it by the total population. Okay, we've got the production function and potential GDP. Okay, neoclassical or the solo growth model, okay, is a framework that we use to determine the underlying sources of growth. Okay, and the particular model tells us that productive capacity and potential GDP are impacted or will go up as a result of if we start to accumulate inputs, capital, labor, raw materials. Okay, or two, the discovery and application of new technologies, okay, that makes the whole process more productive. Okay, and we call the model, call it the production function. Okay, and now we can see over here Y, or output, can be described as a function of quantity of labor. Okay, L, K is capital. Okay, and a big one is technology, knowledge, or we always refer to that as the TFP, the total factor productivity. Okay, and that's almost the TFP, or the level of technology, okay, is what we call a scale factor. It reflects the portion of growth not accounted for by capital and labor inputs. Okay, and of course the key component between total factor productivity is technological changes. Okay, two assumptions about the production function, okay, that provides a link back to microeconomics. Okay, the assumption that the production function has constant returns to scale. Okay, what does that mean? If all the inputs in the production process are increased by the same percentage, output will rise by that same percentage. So in other words, if you double your inputs, you'll double your output, etc. The assumption that the production function exhibits diminishing marginal productivity with respect to any individual input. It can't carry on going up and up and up forever. Okay, top of page 34. Labor and capital have diminishing marginal productivity. Okay, and as a result, the only way to sustain growth in potential GDP then is to make use of total factor productivity or increased technology. Okay, by using the production function, Robert Solow, who developed the formula, the model, okay, he explained the contribution then of the factors. Remember again, labor and capital are exhaustive, okay, and can't go on forever. Technology is then needed for economic growth. And what is he saying? The growth of potential GDP is equal to the growth of technology, labor, and capital. Okay, W and W are the weightings that you've got. Remember, when you're looking at your particular productive process, how much of it, W is the weighting, percentages, okay, related to labor, and then capital. Okay. The capital share is the sum of the corporate profits, net interest income, and net rental income, okay, and depreciation divided by GDP. The labor component is just the employee compensation. That's its cost, okay, divided by GDP. Okay. Transforming the growth accounting equation into per capita terms, what would that say? The growth of A, that's technology, plus, okay, WC, that is the weighting of my capital, okay, times the growth in capital to labor ratio. Okay, we continue onwards. Learning outcome, describe the production function approach to analyzing sources of economic growth. Okay, economic growth and sustainability. Economic growth is the annual percentage change in real GDP or the annual change in per capita GDP. There is a bit of repetition over here, as you can see. Top of page 35, what are some of the sources of economic growth? Raw materials, labor, capital, human capital, and technology. Okay, the sustainable growth rate is the rate of increase in the economy's potential GDP. Labor supply. Okay. Labor supply, total hours worked is the labor force times the average hours that each worker works. What is the labor force? That's the portion of the working age population over age 16, seems a bit young, that's employed or available for work, but perhaps is not working. Okay. Human capital, in addition to the amount of labor that's being put in, the quality of the labor force is important as well. Human capital talks about the accumulated knowledge and skill that workers will get from education, training, and life experiences. And that, in a sense, measures the quality of the workforce. Physical capital stock. Okay, the physical capital stock increases year on year. Okay, as long as we're making net investments in capital over the period. Okay, technology, the most important factor affecting economic growth, as we've spoken many times, is technology. And one of the reasons for that, of course, guys, is because the other factors, which is labor and capital, are exhaustive and cannot continue on producing at high levels all of the time. So there's going to be a point where, of course, we say, hold on a second, okay, that it's going to stop at a certain point in time. Whereas if you've got technology, you can keep improving your processes. Okay, that is where the growth will come from. Top of page 36. Okay, technological advances are discoveries that make it possible to produce with what I've got already more or higher quality goods with the same resources or inputs. Okay, total factor productivity that we spoke about a bit earlier is the component of productivity, okay, that almost acts as a bit of a proxy for technological progress and organizational efficiency. Okay, and when you're trying to measure TFP, it's the amount by which output would increase as a result of improvements in my process, my production process. Okay, how do we calculate this? Okay, TFP growth is the growth in potential GDP, okay, less labor and capital in their correct weightings, of course, because remember, those are going to stay the same. So if my potential, let's say, for example, my potential GDP has gone up to, I don't know, 10%, and labor was 2% and capital was 5%, we subtract those and we can see that the growth that came as a result in my GDP, 2% was from labor, 5% was from capital. The balance must then have come from total factor productivity or technology. We talk a little bit about raw materials. Of course, that's essential to the input. Okay, it's an essential input to growth. Okay, includes things like land, oil, water, etc., etc. We talk about two categories of natural resources: those that are renewable and can be replenished, things like forests, trees, and those that are non-renewable. Okay, once they are extracted, oil, coal, well, then you've extracted them. Okay. Learning outcome statement: define and contrast input growth and growth of total factor productivity, both of them as being components then of economic growth. Okay, when we talk about measures of sustainable growth, we spoke about technology, okay, as well as growth in the rate of labor, physical and human capital, and natural resources. Okay, if you've seen this once, you've seen it twice. Growth in potential GDP is growth in technology. Growth in labor and capital, don't forget to give them their correct weightings as they are in the production process. Remembering, of course, that the two weightings, the weighting of labor as well as the weighting of capital, okay, would of course sum to 100%. Okay, the challenge that we've got, okay, is there's no real observed data on potential GDP or total factor productivity. Okay, very difficult items to observe, if at all. Okay, and based on that, both of those items then need to be estimated. As an alternative, okay, we could focus then on the labor force, where we've generally got some good and reliable data. Okay, labor productivity, we know this already. Okay, it's real GDP for a given year divided by the total hours worked in that year, taking into account all of the workers. Okay, so labor productivity is real GDP over aggregate hours. What about productivity? Okay, we've spoken about that, of course, already. Education, skill of workers, investment in physical capital, etc. Okay, if we then take the production function divided by 1 over L, what do we get? Okay, so Y over L, okay, is the output per worker. Y is the output, L, of course, is the worker, which is a measure of labor productivity. What does this equation tell us? Okay, it tells us that the labor productivity will depend on physical capital per worker. That's the K, as well as A, the technology. We spoke about A many times before. A is called TFP, total factor productivity. Okay. Level of labor productivity. The higher the level of labor productivity, the more goods, the more services the economy can produce with the same number of workers. Always we try and get them as productive as possible because that'll increase our output. Growth rate of labor productivity is the percentage increase in productivity over a year. If productivity growth is rapid, then we say that the same number of workers can produce more and more goods and services. Companies can afford to pay high wages and still make a profit. Over our page, top of page 38, I'm sure people are relieved we are coming to the end of this rather lengthy learning module 3, but an important one as we move, of course, from here, the pre-reads then over on into the core material. Measuring sustainable growth, how do we do that? Potential GDP is equal to aggregate hours worked to how productive the labor force is. Okay, if you want to transform that equation into growth rates, what do you get? Okay, potential growth rate is the long-term growth rate of the labor force plus the long-term labor productivity growth rate. Okay, that then brings us to a conclusion of learning module number 3, aggregate output prices and economic growth. There is a bit of a summary for you there on page 39, following on then onto page 40, okay, and 41. Okay, as you can see, it was a rather long learning module, and on to page 42. As per usual, guys, I always ask, if you don't mind, when you are finished a particular learning module, always go back to the beginning of that particular learning module, okay, and just take a look again then at the learning outcome statements. And you can see for learning module 3 there were a couple of them, okay, and just make sure that you read through those again and you say, okay, yes, I know a little bit about that, that makes sense, yes, I've seen that, I understand that, I remember that, as opposed to reading something and you say, hold on a second, something about short run stagflation, short run inflationary gaps, recessionary gaps. No, I have no idea what that is. That's not a good sign generally, and perhaps it might be advisable to watch the video again, go through the notes again. But yes, if you do come through here and you can, all your learning outcome statements are familiar to you, you've done a good job, and you're probably very familiar then with the particular reading. That then concludes learning module number 3.